see everybody again this month. Thanks for being here. These are always fun to give a catch up on what we're looking at and thinking about. So here we go. Let's dive in. So stat of the day, yesterday, Old Mission Capital's daily newsletter, they're a ETF. They do execution for ETF trades. So they know the ETF market in and out. And they said 95% of all US listed equity and fixed income ETFs over the past 12 months are negative. That is an ugly market, and there's been no place to be safe. Thinking back to the 2020 market crash, it was very easy. You could go to treasury bonds and you made money while the markets crashed and looked terrible, but there was a safety asset. Right now, there is no safety asset. It's crazy. It's not gold. It's not stocks. It's not bonds. Maybe commodities, but they're sketchy. It's just been a huge mess. And it's been really hard to find something that's working. And certainly for that, something that works more than a couple of days. And we were joking about how we really have the three bears, the stocks, the bonds, and the commodities. They're all in bear markets. And usually you have one that's not while the others are. And that's just where we're sitting. So even the gold bugs they're not making money either. And they love to say it's the inflation hedge. And it's not. It really isn't. It's a random asset that doesn't correlate with that, even though people love to say that it is. So don't believe it. Cash really is king right now. Money market's good. Although there are a couple of cycles and seasonality things that are coming up that I think are really interesting. And we'll get to those in a minute. So our long-term trend. We're way down here and we're way stretched. Usually the further it gets stretched, you kind of get a reversion to the mean, which means it would bounce back to the midline. And that for this is a 55-day moving average of the money flow coming in and out of the market. So we've kind of gotten so stretched where all stocks are going down that it's likely to have a bounce. We had that a little while ago, like last week, and then it kind of failed. We had it back here and it failed. We're getting a lot of failures, even though it's trying. But I think, again, seasonality things, a couple things are happening right now that could be different. I'll show you those. The midterm cycle, we had this didn't actually show up. We had a couple of fake out basically that said, hey, things are looking better and you probably want to start taking advantage of it. So we did. It didn't totally work out and it failed. So there we go. We also did some studies on this recently, and thanks, Christine, for doing the help on this, that typically we're looking at more the 200 in this environment. We're looking more for a 200 plus number versus just a positive versus negative before the trends really seem to pick up and carry through and follow through on an up move. So we're watching that more carefully now if we get a positive 200 versus just is it positive? Because we've had a lot of messy fake outs even before here, certainly at the beginning of the year. And here we did, and here's really close. And that is, so it's messy and trying to make sure we're on the right side of these trades. But that's helping. So right now, the money flow is negative. It might improve after today. We got bad news on our inflation. Inflation is, again, worse than expected, but that could be positive for what the Fed does going forward, because now we know they're going to increase rates probably twice, probably 75 basis points twice before the end of the year. If that, that's the unknown. And when that becomes known, the fear kind of disappears out of the market. So I'm optimistic that we'll see a little more stability going forward. And again, seasonality dictates that that's probably where we're at. Sectors right now, not positive sector, it's energy. That's the only thing. And it's been messy, but it's been positive. So you can't argue with that. But from a directional momentum standpoint, everything else has been negative, but we have a lot of MACD positive, basic materials, communications, industrials, consumer staples are doing all right, and they're actually turning positive on the MACD. That actually is a good early warning of shifts to happen. And interesting, back when we had that fake out, all of these MACDs went positive, but none of them moved from the right to the left side. The blanking on what that's called. The momentum stayed on here. The sellers stayed in charge, even though the underlying started to push that way. So it was an interesting fake out. But I think we're seeing that build up again, but slower and a little bit more deliberate. That could be a positive again. I do want to see more ETFs move to that side, more sectors of the S&P moving positive. Then I think we'll have a good chance to see another rally like we did back here in July, back here in March. Is that March? No, sorry. March was here. July was here. This was a mess. This was a mess. Little bear trap. Kind of what happened here again. We had a lot of money flow coming in, and then no, it failed, and you had to get out. But I think there are some things that are going positively that could change where this is at. So right now we're kind of bottoming where we did a couple of weeks ago, but we're not hitting these huge new bottoms, and today is positive. So when things are going down, you get these big spikes down, a rebound, and then it dips further before it goes up. Again, here dips further, here it's just kind of staying there. So I'm curious if this is the line in the sand where buyers start saying, okay, this is when it gets to that point, I'm interested in having more money invested in the market. And that's where they step in and buy. And that could be a good deal to be buying. And that's something we're actually looking at today. Is there anything we should be looking at adding to? From the relative rotation graph, this is all the sectors versus treasury bills. On our primer video, I do go into more depth on what a lot of this stuff is. So if you need that, go check it out on YouTube. But energy is by far the most positive. It's in the leading category. All the sectors, they really got sad looking. They were all really running up, and that's something else we saw last week. And then the last couple of days, they've been just a little scared, a little skittish. Utilities are an absolute mess. I can't believe a safe category like that is going over a cliff, and so is real estate. As far as the ETF, the real estate markets are getting interesting as well with the higher interest rates. But the ETF market, that's a little more commercial. It's having some interesting difficulties as well, but it could be completely oversold at this point. We could see a run in those areas as well before the end of the year. Right now, the only ones we've been favoring have been energy and healthcare. They're the closest to going green, and that's really what I want to see. When all of these start pushing up into this upper right, the whole market should push up with it, and that's the expectation. We're watching this. I like to see the improving box, but I want to see them leading, and then we should look pretty good. Quick comparison. The blue line is where we are year to date. The green line here is 2008. So this week, and that many years ago, 2008, this is when everything was falling apart. This is when Lehman Brothers was failing. This is when all the banking crisis was in full force, and we were just going straight off a cliff. Now, luckily, we don't seem to have that kind of crisis going on. We've got a lot of interesting, ugly badness going on in the market right now, but it's not to that effect. Not saying it couldn't, but I don't think we're going to have this follow through like we did, even though most of this year has been worse than 2008 as a year to date. Except for a couple minutes there, and right now it's not anymore. But most of this year has just been a mess. But on the positive note, I want to end on something positive from Jeff Hirsch at the Stock Traders Almanac. He does awesome work with cycles and understanding where things go and what typically happens. And there's a lot that happens cyclically that I don't think we even really understand why it happens. It's almost like human nature. It's like, well, it's fall, so therefore this will happen. Yom Kippur, for example, is a great bottom of the market. And typically that's when a run to the end of the year happens. The blue line here is the composite of all stock market cycles from 1946 to 2021. This yellow line, orange line is actually 2022. So it really actually follows it, even though it's been messier. Right. So March to here, we had typically the average is a run up. We kind of had a run up and then a failure, but it was there. And then from April to July, you have kind of a sell off in the markets. And that's pretty much what we had, although much more drastic. Really from July to September, late August, it's another run up. We did see that briefly, but this year it failed pretty quick and fell into October. And then what happens after a bottom in October, right around Yom Kippur? Typically it goes up, and that's a lot of average years, and it's just fascinating because I think people are away from vacation, they're coming back, they're looking how to make money into the end of the year, and I think that does drive a lot of buying in the market. So I'm curious as that plays out. It doesn't always, of course. 2008 it didn't, 2018 it didn't. There were a lot of other things happening at that time, but I think now that we know about inflation, we know unemployment, which got better, but it was bad for the market. Now we have a lot of the unknowns are known. So we know that the Fed has to be more aggressive on their interest rate increases, but that's going to be bad for the future, right? That's going to drive unemployment higher, which is what they want. They need unemployment to be up and they need inflation to come down, and they've got the opposite. So they've got to really be aggressive, but it's going to be a mess on the economy to make that happen. So that's what we're looking at and what we're thinking about. Thanks for being here, and we'll see you next time.